Hello everyone, it's Chuck Carnival, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Seeking Alpha subscription marketplace site, the Dividend Kings. And a stock that we just recently added to our high-yield blue chip portfolio was Carnival Corporation. You can see here by the green dot that we added it on July 8th, 2019. And I wanted to kind of go over that because at first glance, this company really looks excellent. The blended PE ratio currently is 10.71. That's significantly below the what I'd call fair value 15 PE ratio, which is depicted by this orange line here. Historically, since going back to 2000, the company's traded at almost 18 times earnings on numerous occasions. That's the blue line, but you can see there are times when it was trading at a lower PE, and one of the lowest PEs that's ever gotten to was during the Great Recession. But certainly this 10.71 PE is quite low. Now I want you to notice that the price tracked earnings over this time frame. I want you to notice that there are times when the price gets above the earnings, I'll call it justified valuation line, and then it reverts to the mean. And then of course during the Great Recession, the stock price fell dramatically, and it's been performing pretty well since then. It got overvalued again in 2018, but then we're now expecting a very flat year, only 2% earnings growth for fiscal 2019, which ends, by the way, in November. This company has a November fiscal year, and the stock price has reacted from going from being overvalued to now being what appears to be very undervalued. But let's take price off of the graph here for a moment, and let's take these transactions off of the graph, and let's take the normal PE off the graph, and let's just look at its operating history and just analyze a little bit. First of all, we see, this is a semi-cyclical company, had decent earnings growth here. Earnings were very flat, for the period from 2000 through 2003. They just kind of, stayed around that $1.50, $1.60, $1.70 range. Then we had good earnings growth coming into the recession, and then we had a drop in earnings in the Great Recession, but the company stayed profitable. Its actual worst years were in 2011, 12, and 13. But here's what I really want you to focus on. This is the dividends paid out to shareholders. This is a plotting of those same dividends, the white line, and this area below here is this light green shaded area while it was still part of the company. Or in other words, this shows a picture of the dividend payout ratio. I want you to notice they completely eliminated the dividend in 2009. They did start paying one again in 2010. They went from $1.60 they paid in 2008. They paid 40 cents in 2010 and then raised it to $1, but then froze it at $1 through 2014 before they started increasing the dividend again, and it's increased pretty nicely since 2015 or 2014 or so. If I shorten this graph and go ahead and look at performance, you can see that the dividend in 2014 grew from $1 to $1.10 to $1.35. So over this short period of time, their dividend record looks quite nice. They've increased it quite well. Their stock price was overvalued in the first couple years, and now it's become inexpensive again. But I want to talk about a couple other aspects. So from a valuation point of view, I think the company appears to be very, very inexpensive right now. Based on earnings, it's obviously very inexpensive. Now, but next I'm going to go look at operating cash flow. Now, this is an important metric when I'm talking about dividend-paying stocks, which is what the Dividend Kings website is all about. When I'm looking at dividend-paying stocks, I'm going to take price off of the graph again. I don't want to contaminate the look here. Operating cash flow was covering the dividend very nicely, but then it was still appeared to be covering it during the Great Recession when they cut the dividend. The operating cash flows dropped a little bit, but they've been rising quite strong. But from an operating cash flow point of view, the company's dividend is covered very nicely. But I want to really focus on this fact that they cut the dividends, and let's look at what I consider to be the acid test, which is free cash flow, when I'm looking at a company's dividend coverage and their ability and willingness to pay dividends. And I will say one thing that's startling about this company. I've been through their most recent earnings reports and reading their transcripts and so on, and even their website doesn't focus very much on dividends. I just want to make that clear. Management doesn't seem to have a real focus on dividends. They talk about growing, increasing returns on invested capital. They talk about, increasing operating earnings and so on, but they don't talk about dividends a lot. But let's look at what happened to their dividend. Now, during the period where their free free cash flow actually turned negative in 2002, 2003, and 2004. And I do want you to notice the company didn't do much with their dividend during that period of time, but they did continue to pay one. Then they had a nice surge in free cash flow, but then free cash flow from 2005 going into the Great Recession dropped precipitously before it finally turned negative in 2009, which, by the way, is when the company cut the dividend. So there was a lot of times during this period where they weren't really covering their dividend with free cash, and this is the cash that's left over. Now, this company is a capital-intensive company. They're going to be adding 19 cruise ships, as I read in some research I conducted, through 2023, so they're spending a lot of their cash, and that's understandable, but the company only has 25% debt and is A- rated. But now as I look at free cash flow from, going from, let's talk 2011 up and through 2018, which is historical still, the company had good cash flows, well covered the dividend, and they made some nice dividend increases during this time. The dividend went from $1 to $1.10 to $1.35 to $1.60 to $1.95, and then it's being forecast to pay $2 next year and $2.15. But what disturbs me about this, and I just want to focus your attention on a risk I see here, and that is the actual free cash flow has been pretty good going back these years, but it's expected to be negative in 2019 and rather meager in 2020 and 2021. Remember, fiscal year ends in November, which means they aren't going to have free cash flow covering their dividend. Now, their operating cash flow and even their EBITDA, which is a form of cash flow, will be covering the dividend. So, it's really hard for me to ascertain right now whether management is going to stick with the dividend policy here or not. I really can't say. I think that should be a focal point of your research. When I look at it from a valuation point of view, whether you're looking at price to EBITDA, price to cash flow, price to earnings, the stock looks extremely cheap. The 4.33% current dividend yield is quite enticing. And if I look at just dividend growth over the last several years, dividend growth has averaged about 14% a year. So that's been very attractive. It's produced more dividend income than the S&P, but it's underperformed it on a capital appreciation. But part of that can be attributed to the fact that the S&P is currently overvalued and this stock is currently undervalued. So I would take that into consideration. I always say measuring performance without simultaneously measuring valuation is a job half done. So looking at the future and forecasts here, analysts expect a flat year this year, which again ends in November, just a few months away, of only 2% growth over last year. But then they expect double-digit growth in, now this is EBITDA I'm looking at here, in 2020, and then 9% growth in 2021. So if this was trading at a more normalized, we'll call it 9 or 10 times EBITDA, this particular is 9.78 times EBITDA, which is realistic for this company. Remember, it currently trades at 6 times EBITDA. There would be multiple expansion here, which could generate some very, very strong rates of return. So the company is cheap. It does offer a very attractive dividend yield, and so far analysts are still expecting dividend growth over the next several years. The real question is, are they going to do that and be willing to do that with free cash flow being what it is or being what it's expected to be? And that's a question that I think really needs to be answered. It's a very high quality company, A- rated, only has 25% debt, so that's not an issue. It's a moderately cyclical company, as we've seen by looking at all of this historical data here. When you're looking at operating earnings or even EBITDA, there is a level of cyclicality that the viewer should basically take into consideration. Spotty dividend record, even though it's been pretty good for the last, let's say, 5, 6, 7 years, but longer term, it's really an unknown to me whether they're going to continue to pay their dividend or not. Anyway, that's my take on Carnival. I think it's very intriguing. It's certainly cheap enough to take some risk. There could be some really great rates of returns, but I think the dividend policy is something that really at least needs to be taken into consideration. Thanks for watching. If you like what you saw here, don't forget to subscribe to our YouTube channel. And some of you are interested in finding attractive dividend growth stocks, you might want to take a look at our Dividend Kings site on Seeking Alpha as well. Thanks again.